What if the greatest shift of wealth in human history isn't coming, but already underway? Not announced with sirens or crashes, but disguised as normal life. Grocery bills creep higher, homes slip out of reach, markets hit records, and officials insist everything is fine. Beneath that calm surface, trillions of dollars are quietly changing hands. This isn't hype, it's math. Most people assume wealth transfers happen during obvious disasters, wars, depressions, revolutions. History says otherwise. The largest transfers unfold during periods that feel ordinary, when complexity hides consequences and time erodes urgency. By the moment the public notices, the transfer is already finished. Right now, we are inside one of those moments. Assets are consolidating. Purchasing power is dissolving. Debt grows faster than income. A small group, armed with information, leverage, and patience, is positioned to exit vastly wealthier. The question isn't whether a wealth transfer is happening. It's whether you'll recognize it before your savings, labor, and future buying power quietly land on someone else's balance sheet. History shows one brutal rule. Those who understand the cycle early survive it, while those who trust appearances fund the outcome they never chose to turn on the news, and you'll hear a reassuring message. The economy is resilient. Employment is strong. Markets are healthy. Inflation is cooling. According to the official story, any pain you feel is temporary, manageable, and ultimately a sign of progress. But history teaches a dangerous lesson. The most consequential economic shifts rarely announce themselves honestly. The real story lives in the gap between statistics and lived experience. If the economy is thriving, why do wages lag behind prices year after year? Why does owning a home require more debt than at any point in history? Why do markets soar while everyday life feels tighter, riskier, and more fragile? These contradictions aren't accidents. They are features of a system quietly redistributing wealth. Official narratives focus on averages. Real wealth transfers happen at the margins. Inflation doesn't hit everyone equally. Asset inflation rewards those who already own assets. Monetary expansion benefits those closest to newly created money first, while everyone else pays later through higher costs and diluted purchasing power. This process has a name in history, even if it's rarely spoken today. What makes this moment especially dangerous is how calm it appears. There is no single villain, no dramatic collapse, no obvious trigger to panic. Instead, there is normalization. People adapt, they borrow more, they save less, they work harder for the same outcome and call it reality. This is how wealth transfers succeed, not through force, but through confusion, not through crisis, but through credibility. The system doesn't need your consent, only your patience. And as long as the official story sounds comforting enough, most people never question where their lost purchasing power actually went. To understand what's happening now, you have to step back from headlines and look at the pattern. Across centuries, cultures, and currencies, wealth transfers follow a remarkably consistent cycle. The names change, the tools evolve, but the sequence stays the same. This is not ideology. It's history repeating under different branding. The cycle always begins with expansion. A society discovers a new source of growth, productive innovation, new trade routes, industrialization, or financial engineering. Credit becomes easier, money flows faster, living standards rise, and optimism spreads. This phase feels like progress, and for a time it is. Most people associate this stage with opportunity and upward mobility because growth is real and broadly shared. Then comes distortion. To maintain momentum, leaders intervene. Credit is loosened further. Debt replaces productivity. Money becomes cheaper, and assets begin to rise faster than wages. Those who own assets grow wealthier simply by holding them. Those who rely on labor fall behind. Inequality widens, but it's explained away as temporary or necessary. Next comes dependency. The system becomes addicted to stimulus. Markets expect support. Governments accumulate obligations they cannot realistically repay. Households take on more debt just to maintain their standard of living. At this stage, stability depends entirely on confidence. Nothing can be allowed to break because too many things are built on leverage. This is where wealth transfers accelerate. Inflation, financial repression, and policy complexity quietly move value from savers to debtors, from workers to asset holders, from the public to institutions. No laws are broken, no alarms are triggered. The transfer happens through time, not force. Eventually, the cycle resolves, sometimes through crisis, sometimes through restructuring, sometimes through a reset of the monetary system itself. By then, ownership has changed. Assets are concentrated, debt is socialized, the public is told this outcome was unavoidable. What matters is not the final stage, but the early ones. History shows that those who recognize the cycle during expansion and distortion can reposition. They shift from promises to assets, from appearances to fundamentals. Those who don't are slowly absorbed into the mechanism itself. Every great wealth transfer starts the same way, With growth, everyone celebrates, followed by distortions most people ignore. By the time the consequences are undeniable, the cycle has already done its work. When people imagine the fall of empires, they picture chaos, fires in the streets, foreign armies at the gates, sudden collapse. History tells a quieter, more unsettling story. Most empires don't fall apart overnight. They hollow out slowly, while daily life continues just enough to keep people from noticing what's being lost. Take Rome. At its height, Rome was unimaginably wealthy. Trade spanned continents. Infrastructure was unmatched. Its currency, the denarius, was trusted across the known world. But as expansion slowed and costs rose, Roman leaders faced a problem every mature empire encounters. Obligations exceeded productivity. Instead of restructuring, they chose dilution. The silver content of Roman coins was quietly reduced, again and again. Officially, nothing had changed. In reality, purchasing power was being siphoned away. Soldiers demanded higher pay. Prices rose. Savers were punished without ever being told why. Wealth shifted from citizens holding currency to the state and its connected elites who controlled land, contracts, and resources. By the time ordinary Romans understood what was happening, the damage was irreversible. Ownership had consolidated. Debt was everywhere. Trust was gone. Rome didn't fall because people panicked. It fell because they adapted too long to a system that no longer worked for them. Centuries later, Britain followed a remarkably similar path. After dominating global trade and finance, Britain emerged from World War II victorious, but financially exhausted. To preserve stability, the government imposed capital controls, high taxes, and prolonged inflation. The public narrative emphasized rebuilding and fairness. The reality was silent confiscation. Inflation eroded savings. Property and productive assets slowly migrated into institutional and government hands. The British pound lost its global reserve status, not in a dramatic collapse, but through decades of decline. What's striking is how normal life felt during these transitions. People worked, markets functioned, governments reassured. But beneath the surface, wealth was being reallocated. Those with real assets, international exposure, or political proximity preserved and grew their influence. Those who trusted wages, pensions, and domestic currency paid the price. The lesson isn't that empires disappear, it's that ownership changes long before power does. Decline is not an event, it's a process. And the most dangerous phase is the one where nothing seems obviously wrong, yet everything fundamental is quietly shifting. Rome and Britain didn't fail because their citizens lacked effort or intelligence. They failed because the system changed faster than public understanding, and history is clear on this point. When monetary integrity breaks, wealth doesn't vanish. It moves, patiently, legally, and almost invisibly, to those positioned to receive it. America likes to think of itself as the exception to history, different system, different values, different outcome. But history doesn't care about intent or identity. It responds to incentives, math, and time. And when you strip away the slogans, America today is following the same late-cycle pattern that defined every dominant power before it. The modern version didn't begin with decline. It began with extraordinary success. After World War II, the United States controlled global manufacturing, energy, trade routes, and the world's reserve currency. Productivity surged. Wages rose alongside growth. One income could support a household, buy a home, and build savings. This was the expansion phase, real prosperity, broadly shared. The shift came quietly. In the 1970s, the dollar was severed from gold, transforming money from a constraint into a policy tool. From that moment on, growth no longer required productivity. It could be manufactured through credit. Debt expanded. Financial markets grew faster than the real economy. Assets appreciated faster than wages. The system still worked, but it began working differently, and not for everyone. Over time, survival replaced growth. Each slowdown required larger interventions. Each crisis demanded more liquidity, lower rates, and greater promises. Households were encouraged to borrow. Governments normalized deficits. Markets learned to expect rescue. What once would have been considered emergency measures became permanent features of the landscape. This is where the wealth transfer accelerates. When money is created faster than value, purchasing power doesn't disappear evenly. It moves. Asset owners benefit first. Institutions with access to cheap capital expand. Meanwhile, wages lag, savings erode, and the cost of necessities climbs. People feel poorer not because they failed, but because the measuring stick keeps shrinking. Home ownership becomes a speculative event instead of a milestone. Retirement depends on market exposure rather than savings. Risk is no longer optional. It's mandatory. And all of this is framed as progress, innovation, inclusion, stability. But step back, and the pattern is unmistakable. Wealth is consolidating into fewer hands. Debt is socialized. The public absorbs volatility while institutions capture upside. This is not collapse. it's consolidation. Just like Rome and Britain, America isn't ending, it's transitioning. Ownership is changing, power is adapting, and those changes happen long before any official acknowledgement. The most revealing sign isn't market crashes or political drama, it's normalization. When record asset prices coexist with widespread financial anxiety, the cycle is already well underway. History shows that by the time people agree something fundamental has changed, the transfer is nearly complete. Every wealth transfer creates winners and losers, but not in the way most people expect. It isn't about intelligence or effort, it's about position. Where you sit in the financial system matters more than how hard you work inside it. Those who gain are closest to assets and credit. Institutions that can borrow cheaply use leverage to acquire real things, property, companies, resources, before prices fully adjust. Asset owners see their balance sheets inflate as money flows into markets first. Debt holders benefit too, because inflation quietly reduces the real value of what they owe. Time works in their favor. Those who lose are paid last. Wage earners feel inflation immediately, but receive adjustments slowly, if at all. Savers watch their purchasing power erode while being told they're being responsible. Retirees dependent on fixed income fall behind every year. The system rewards exposure and punishes caution. This is where the transfer becomes personal. If most of your wealth exists as promises, cash, wages, pensions, you are funding the process. If it exists as assets, ownership stakes, productive property, scarce resources, you are benefiting from it. The uncomfortable truth is that the system doesn't need to collapse to take from you. It only needs to change the rules quietly. Inflation acts like a tax no one votes on. Asset inflation acts like a gate that closes after insiders pass through. Complexity obscures accountability, and time does the rest. Ask yourself an honest question. When prices rise, who gets paid first, and who absorbs the delay? History shows that this single distinction determines who exits a wealth transfer stronger and who wonders where their progress went. The most dangerous part of any wealth transfer is not the crash, it's the calm. History shows that by the time fear becomes obvious, the real damage has already been done. The largest transfers happen during periods that feel stable enough to tolerate, even as the foundation quietly shifts. This is the silent phase. There are no breadlines, no bank runs, no dramatic headlines forcing action. Instead, there is adjustment. People downsize expectations, they normalize debt, they accept that things feel harder than they used to, and assume that's just how modern life works. This psychological adaptation is what allows the transfer to complete without resistance. Information lag plays a critical role. Economic data is delayed, revised, and averaged. Official metrics smooth over lived reality. By the time statistics confirm what households already feel, years have passed. Media narratives reinforce patience, insisting conditions are temporary, external, or about to improve. Each reassurance buys the system more time. Distraction is equally powerful. Political drama, cultural conflict, and endless crises compete for attention. When everything feels urgent, nothing feels actionable. People focus on symptoms instead of structure. They argue about personalities while ownership quietly changes hands in the background. History is full of examples where populations sensed something was wrong, but couldn't identify it clearly enough to respond. In Weimar Germany, many continued saving in cash as inflation accelerated, convinced stability would return. In post-war Britain, citizens trusted institutions to protect pensions and purchasing power long after the math had turned against them. In each case, the realization came too late. What makes the silent phase so effective is that it doesn't feel like theft. It feels like erosion. No single moment demands action. Loss accumulates gradually, almost invisibly, until people look back and realize how much ground they've lost. This is why timing matters more than certainty. You don't need to predict the exact outcome to respond intelligently. You only need to recognize the phase you're in. History shows that those who wait for clarity usually get it, right after the opportunity to act has passed. History doesn't offer precise forecasts, but it does offer boundaries. When societies reach this stage of the cycle, high debt, distorted incentives, concentrated ownership, the range of possible outcomes narrows. The details differ, but the direction rarely does. One path is tightening. Inflation forces policymakers to restore credibility, often by raising rates, cutting support, or allowing weaker participants to fail. This feels like discipline, but it usually arrives late, after excess has already accumulated. The result is pain that falls hardest on those least prepared, over-leveraged households, late investors, and workers dependent on fragile systems. Another path is restructuring. Debts are reworked, implicitly or explicitly. Savings may be trapped, pensions adjusted, obligations redefined. This can happen through inflation, regulation, or financial engineering rather than outright default. The language is always technical. The effect is always the same. Claims are reduced, and ownership becomes clearer. Sometimes the resolution is monetary, a reset, rebrand, or re-anchoring of the currency. This doesn't erase wealth, but it redraws the scoreboard. Those holding real assets transition smoothly. Those holding promises discover their terms have changed. What never happens is a painless return to the old system. Once a cycle reaches this point, reversal is no longer an option. Only transition remains. Stability gives way to volatility, confidence gives way to negotiation, and systems that once felt permanent reveal themselves as conditional. This is why waiting for confirmation is so dangerous. By the time the next phase is obvious, positioning is no longer flexible. History rewards those who act when outcomes are still uncertain, but patterns are clear. It punishes those who wait for permission. You don't need to know exactly how this ends. You only need to know that it won't end by preserving the status quo. And that realization changes what preparation really means. The biggest mistake people make during a wealth transfer is assuming there will be a clear signal to act. History shows the opposite. The moment consensus forms, the window has already narrowed. By then, assets are repriced, rules are rewritten, and opportunities that once required foresight now demand sacrifice. What this period demands is not panic, but perspective. Understanding where you are in the cycle changes how you interpret everything else. Headlines, policies, markets, even personal financial decisions. It reframes risk. It clarifies why doing nothing is often the riskiest choice of all. Every major transfer leaves behind the same lesson. Wealth is not destroyed in these moments. It is reassigned. Those who recognized the pattern early shifted away from promises and toward ownership. They prioritized resilience over yield, optionality over comfort, and long-term survival over short-term approval. This channel exists for one reason: to study these cycles before they finish, not after they're taught in textbooks. In the next videos, we'll break down how past individuals and institutions protected themselves when systems changed, and what that means today. History rewards preparation made early, quietly, and deliberately, long before official confirmation ever arrives public.